This is our very first ever Opportunity Zone Investor Roundtable. As I mentioned before, it's going to be an informal discussion of what we like about Opportunity Zones, how we use Opportunity Zones in our investment portfolios. So I'm going to go around the horn here and get a little word from everybody to get started. Let's just go around in alphabetical order by last name. So I'm Jimmy Atkinson. As you may know me, I'm the founder of Opportunity DB. I was attracted to Opportunity Zones in the early days, in 2018, the day I heard about them. And I became an investor a couple years later in several Opportunity Zone deals once I became more familiar with the process. Jack, I can go to you next. Jack Cust, how are you doing? Why don't you give yourself a quick introduction and what attracted you to Opportunity Zones, Jack?
Sure, Jimmy. Hi, Jimmy. It's a pleasure to be with you today. And I'm a retired CPA, and I'm managing our family office, which includes two self-sponsored Opportunity Zone projects. One is a 400,000 square foot mixed-use town center in Flemington, New Jersey, one of the wealthiest. It's in one of the wealthiest counties in the country, anchored by a Marriott multi-housing and a restaurant city. The other one is an OZB, which we have a national recycling company that we started. And that's an exciting thing because the recycling business is really a pretty interesting industry. So we kind of have our foot in both multi-housing and also the OZB. So it's exciting. I mean, it's a great program.
It sure is, and we'll talk a little bit more about what you're bullish on and your particular deals a little bit later during today's panel. Jack, Seth, let me turn to you next. Why don't you give us a quick intro? Who are you? What attracted you to Opportunity Zones?
So I'm a financial planner focused on tax mitigation. And aside from all of that, I use the Opportunity Zone Fund for both my business. I'm a partner in an Opportunity Zone Fund down in Puerto Rico, mixed hospitality fund. So really, I use it as just another tax strategy. And I use it for my personal business, and I use a fair amount of clients with it, just kind of to push the envelope, a little bit of tax diversity.
Very good. And then Remy Szykier also joining us today. Remy, quick introduction to you and what attracted you to Opportunity Zones.
So one is with Opportunity Zones, and I come a little bit more from technology and healthcare. And so what we were brought in from different investment and developers is looking at where you can create more social equity, if you will, and prosperity. And so with that, with economic development, where we've been brought in from different developers, so that's everything from multifamily to building new communities, sustainable communities, looking at climate, and then from the health perspective, looking at healthy building. So we're involved in that initiative nationally. But with the Opportunity Zones, there's an opportunity not just from the tax and the investment perspective, but then also looking at social impact. So bringing in investment that actually has another triple bottom line, if you will, in terms of what those investments look like. So in the Mid-Atlantic, we've been a little bit more focused in home health care, nursing, and assisted living facilities. And then looking at in Texas, Rhode Island, and South Carolina, and in Connecticut, we've been focused a little bit more in the multifamily and building out those type of investments for real estate.
Very good. Well, again, thank you to the three of you for joining me today. You know, we have a lot of people on the line right now who, some of them have been to OZ Pitch Day before. Some of them have made Opportunity Zone investments before. A lot of them this is their first interaction with Opportunity Zone Pitch Day. They might be getting ready to make their very first Opportunity Zone investment, or they just want to learn more about it. So the reason for this panel, the purpose of this panel, is to help familiarize you with Opportunity Zone investments and to make you more comfortable potentially making Opportunity Zone investments. You can hear it from 4 people, myself included here, that have made these types of investments in the past. So wanted to get a sense of what are the types of gains that each one of us had that we rolled over into qualified Opportunity Zone funds over the past few months or few years. And Jack, I'll start with you. What kind of gains did you have that you rolled over?
Our gains in our family businesses, we have a lot of different things we're involved in. So we've rolled quite a bit of money, in excess of $10 million in gains, into our Opportunity Zone projects, as well as attracting some friends and family. So it's been a great tool to use. I was a practicing CPA for 40 years, and I've really, quite frankly, never seen anything that's as good as these Opportunity Zone regulations. I mean, they're just phenomenal. And if you want to have a good deal, and if you take advantage of these tax situations, it just makes a good deal a great deal, and a great deal a phenomenal deal.
It does. No, it doesn't make a bad deal a good deal, because at the end of the day, this is a capital gains tax incentive program, and you better have capital gains at the end of the 10 years. Otherwise, it's not really worth your while.
Jack, on a pig or something like that. Yeah.
That's right. Jack, where did your gains originate from? You sold privately held business or what?
Yes, privately held businesses and some real estate and some stocks.
Good. A little bit of everything from you, it sounds like. By the way, for me,
what happens is we use our family office, and we coordinate the Opportunity Zone projects, and we just manage our portfolio, and any gains we have, we just put them into our Opportunity Zone funds.
Very good. So for me personally, by the way, my gains that I rolled over in 2020 and 2021 were stemmed from highly appreciated low basis stock that I held in mutual funds for 15 plus years. I divested some of my own stock portfolio specifically for 2 reasons, basically. One, to get out. Well, I felt like I was over exposed to stocks. I like to keep a certain asset allocation, and my asset allocation, my exposure to stocks kept creeping up and up and up as the stock market had its run up over the last 15 years. So that was one reason, just take some chips off the table and get that stock allocation back to where I wanted it to. And 2, to diversify my portfolio a little bit. I think, unlike the 3 of you, I didn't really have any exposure to real estate previously to investing in Opportunity Zone funds starting in 2020 and 2021. I also had some privately held business that I sold some interests in as well. Seth, turning to you now. How about you?
So
what types of gains did you roll over into Opportunity Zones?
I sold all of my real estate on the East Coast after moving out to Arizona to be with my wife's family. So, and I probably timed it as close to perfect as possible. So I think I sold it at within one month or 2 of the peak of the market. So I sold all of that. I also closed 2 small businesses that had East Coast nexus that weren't going to move effectively. So just kind of as I repositioned where my businesses and plans were.
Very good. And Remy, turning to you, where did your gains come from?
Well, what we've looked at is, you've mentioned family offices from Jack, then looking at different investors or developers and financing. The real opportunity has been, to your point, with the capital gains, and looking at where from economic development, there's where you have the direct investment, and then there's additional government financing that has come to the table in addition to the tax credits per se. But there's a huge opportunity for, again, looking at that triple bottom line, for looking at where you can create prosperity and be able to from an economic development perspective, have additional benefits outside of just the initial investment.
Yeah, no, I think that's so important, Remy. If I can just get on my soapbox for a minute here, the opportunity zone policy was designed to create impact in these low income communities all over the country. There's 8,700 plus of them. Now, that said, a lot of investors aren't focused on impact. They could care less about impact, quite frankly, and they really just want a market rate return. There are a fair amount of investors out there who are impact investors who were attracted to opportunity zones for that reason. But I would say, at least, I don't know, this is my opinion at least, no matter what type of investor you are, if you're just a market rate investor focused purely on your after-tax returns, we welcome you to opportunity zone investing. Or if you're an impact investor and you're sure you want a little bit of return, but you're looking for some social impact on top of that, we absolutely welcome you as well. In either case, either type of investor, you're both bringing private capital into these areas that, in theory at least, are going to be catalyzing investments that can turn around that community. So whether even if you're just a market rate investor, you might get a market rate great after-tax return, but you're probably also helping to produce some sort of impact in those communities regardless. Some projects are more impactful than others, but all of these projects, at least the intent of the policy, is to catalyze economic revitalization in a lot of these areas. Now, I wanted to discuss how opportunity zones really fit into our investment portfolios. That was actually the title of today's panel. If you check our agenda, is how opportunity zones fit into our investment portfolios. Because so often we focus here on just very narrowly opportunity zones. I love talking about opportunity zones, but sometimes you have to take a step back and consider, well, how do OZs fit within the entirety of an individual's or a family office's overall investment portfolio? What percentage should it be? What percentage of your portfolio just in general should you have in these types of opportunistic, higher risk type of assets? Jack, I'll start with you. What is your take on how OZs fit within your family's broader investment portfolio?
It's really a perfect fit for us. As I mentioned before, we have a family office and we have multiple businesses in real estate. So we look at this opportunity zone as a situation where we can rearrange our assets in our portfolio and divest of them and convert them into the opportunity zone. And then at the end of 10 years, basically create everything that's tax-free. And when you look at the leverage and what you can accomplish out of it, it's an unbelievable situation if you can take advantage of it.
Yeah, and Seth, turning to you, that bigger question. If you zoom out and look at your entire investment portfolios, what role does opportunity zones play?
So the first thing I have to do as a financial planner is to challenge the assertion that these investments are riskier, because an opportunity zone is not an investment. An opportunity zone is a wrapper around an investment. So a good investment will gain these additional benefits, and then on top of it, if it's planned right, will add some exceptional tax diversity into your financial life, which, if anything, is going to make the investment less risky. Now, by their nature, they are illiquid, but I would again play the question of that most investors should probably be investing in more illiquid things, that people tend to focus too much on liquidity, and liquidity destroys long-term growth and value. What do you need? Why does your retirement fund or your retirement situation need to be in something you can sell tomorrow if you're not going to retire for 20 years? Who cares? There'll be ups, there'll be downs. And so if you look at a long-term strategy, you're actually putting yourself in a lower risk situation. And then you can take it to the extreme. So I gave appreciated property to my 12-year-old and my 4-month-old, which is then invested with the capital gains into our opportunity zone fund. And we don't tend to liquidate that opportunity zone fund until the 2040, what did we say, 2047 the other day?
Yep.
Is the requirement. So my, 4-month-old is coming out with a tax-free gain on a property that we're expecting to have consistent double-digit returns, and he's going to come out with no tax burden on that.
Seth Rosenberg, everybody, he's playing 3D chess. The rest of us are playing, maybe we're playing chess, maybe we're playing checkers. This guy, long-term planning, I love it. By the way, I loved your point about liquidity and illiquidity. My partner, Andy Hagans, he discusses that illiquidity premium concept that you touched on, Seth, quite frequently on his podcast, the Alternative Investment Podcast. It was made famous in part, at least to us. We became aware of it because of David Swenson's work on the Yale Endowment Fund. He was one of the first to really popularize that concept. Yale and other universities, these big endowment funds, they don't need liquidity. They're drawing down maybe 1 or 2% of their portfolio a year for their operating costs. But I think you can apply that to a wealthy individual or family as well. Why do you need all of your portfolio, or 90% of your portfolio, or even 50% of your portfolio in liquid assets? Your retirement portfolio doesn't need to be liquid for another 20 years. I think it's a great point. And typically you do achieve an illiquidity premium when you are in illiquid assets. I think it's a great point. Seth, Remy, how about you? How do you consider opportunity zone investments within your broader portfolio? What role do they play for you?
Well, some of them, I mean, you are looking at the 10-year mark, if you will, but what you're also looking at is what can you look at in the midterm. So if you're looking at 3, 5, 7 years before you hit the 10 years, how you're appreciating in the value and increasing or multiplying the value of that asset. And with the opportunity zones, I think that coming in early, you're definitely going to have the value in the long term, but having the ability to build a multiplication of the different assets together. So you start with one, but then you have additional things that you are bringing in as investments together. And then at the 10-year mark, you're able to have a multiple of where you started at the beginning.
Very good. And then for me, I'll just kind of comment on this one before we move on to the next topic. I consider opportunity zones broadly within my investment portfolio as, Seth, I actually think I agree with you. Again, just to say, like, it's my illiquid portion of my investment portfolio, along with some privately held business that I own outside of my opportunity zone investments. I do have a fair amount of my net worth tied up into illiquid assets, although I don't know, maybe according to Seth, maybe probably not enough. And I should probably get my 2-month-old some opportunity zone assets. Seth, I need to call you after this and talk to you about that. But I would say roughly 10 to 15% of my overall investment portfolio is in a handful of different qualified opportunity funds. And for me, like I mentioned a few minutes ago, it was a way to diversify my portfolio. I didn't have any exposure to real estate outside of my primary residence. So I wanted to grab a little bit of a diversified real estate investment portfolio through my opportunity zone funds that I've invested in. And I'm not, one other point I want to make. We've talked about the 10-year hold and that 10-year mark a handful of times throughout the course of today and during this panel. I oftentimes get pushback from investors when I'm first teaching them about opportunity zones and explain to them, oh, by the way, you have to hold your investment for 10 years or more before you achieve the full benefit. That raises some eyebrows and gets worries some investors, like, oh, man, I kind of want to be able to cash out sooner than that. And I like to redirect that frame for them to consider, well, you should think about this as an unlimited tax-free growth type of vehicle. It's akin to a Roth IRA. It's a super Roth IRA, as Ashley Tyson and I have referred to it multiple times in the past. And if you have a Roth IRA, you're not chomping at the bit, waiting to take that money out as soon as you possibly can. You don't really consider it as part of your overall liquid investment portfolio. It's just this illiquid part of your portfolio that you're saving for retirement, which may be 5, 10, 20, 30 years or more. Maybe for your 4-month-old Seth, maybe it's 60 years down the line, right? And so you shouldn't be thinking about how soon can I get out in order to achieve the tax benefit. You should be considering how long can I stay in? How long can I let this investment eat for? And Seth and I just point out, currently in the regulations, it's through the end of 2047. So that was just one more point that I wanted to make.
Jimmy, with respect to that, I just want to note that the response to that is also take a thought
that
item.
You might be bullish on. Jack, what type of deals do you like in your opportunity zone portfolio? Are there any broad sectors that you like that you're bullish on, or if you want to talk about specific deals, be as broad or get as specific as you want to?
Well, I like the deals that we're in because, you know, we vet a lot of deals over the years. We've looked at a lot of different things, done a lot of work in the real estate area, and we always like real estate because just economically, you know, real estate, pretty simply, you make your money from cash flow, from appreciation, and from amortization of debt. So when you look at that and combine that, and then you put the tax impact on top of it that's available with the opportunity zones, it becomes phenomenal. I'll just point this out, if I may. When you talk about liquidity and tying up your cash, you have 3 opportunities, and Eric Hayden talked about this in your previous previous segment.
Mm-hmm.
You know, you have a refinance opportunity that comes into play that a lot of people can take advantage of. You also, you know, in most of the real estate stuff, you try to target 8 to 10% in cash flow, which is tax sheltered, and you're going to have some cash flow from there. And, you know, one of the other things that came up recently that's been talked about is the difficulty with the higher interest rates right now. And because of the higher interest rates, we mitigated that by raising more capital and paying a guaranteed return payment to investors for their capital. You're allowed to do that without making a disqualifying event. So we pay our investors 3.5%. When you look at the comparison of that to interest rate costs, you can gain a lot more capital and you can create a little more cash flow for people. So you can play with some of these challenges with cash flow and getting your money back, and, you know, trying to create some shelter. And there's ways to do it so that you really still have a viable investment, and not really tying up your cash and just saying it's there, I'll never forget about it forever.
No, great point there. I mean, eventually, you know, we're all of the OZ deals that I'm currently invested in, none of them is cash flowing at the moment, but eventually you do want to have some cash flow coming your way before even that liquidation event, 10 plus years down the line. Seth, what about you? Any sectors or particular deals that you're particularly bullish on?
So first, I just want to touch real quickly that remember that the downside on or not, it's not really a downside when it comes to illiquidity, because if I need to pull money out prematurely, most funds will permit it. And while there's going to be a small tax hit, the hope is that you don't need to. That's always your insurance policy. You can still get at money. You're going to lose some of the tax benefit, but that's not the end of the day if you need to pull the money out. With respect to the opportunity zone side of things, I like to take advantage of something that just makes opportunity zones amazing and combined. So with real estate, there's already accelerated depreciation, except in an opportunity zone, there's no depreciation recapture. So we want to maximize that. And I want to combine that with an operating business. So for example, my hospitality fund down in Puerto Rico, we are looking to maximize what we can do inside the fund without having a taxable distribution to people, increasing their, just layering that gain up. If you were to 1031 something instead of using an opportunity zone fund, you can't 1031 into an operating business. You can only deal with the real estate side of it. But if you have real estate that is also an operating business, you are diversifying your risk. You're saying, hey, if the real estate value is down, but the operating business itself is up, well, I'm still a net positive, and vice versa.
Yeah, great points there. You can, under a lot of cases, you can usually get the money out if you need to. Oh, go ahead, Remy. Go ahead. Sorry about
Puerto
that.
Rico specific. Oh no, I was going to say Puerto Rico with the opportunity zones, and I would say 90% of Puerto Rico is an opportunity zone. Maybe Seth, you can expand a little bit more in terms of how you've navigated in Puerto Rico.
So I wasn't sure. So I think that the Puerto Rico does add an added benefit, as Remy mentioned, that almost the entirety of the island is an opportunity zone, but it doesn't matter whether it's Puerto Rico or other places around the country. The vast majority of opportunity zones are also eligible for some other special tax treatment. And you should be looking to make sure that the operator, or if it's a direct investment, is taking advantage of those additional benefits and making sure they're maximizing them. Because at the end of the day, you can achieve that impact by layering. The more we can layer on, the more Uncle Sam's going to help me complete my project, the better the number is.
Yeah, Seth, I think that's crucial that you point that out. I mean, so like opportunity zones are really oftentimes just one piece of the capital stack for a lot of these different projects, right? And you can oftentimes, because it's an opportunity zone, it's probably eligible for a lot of other types of tax credits, or either from the federal government or from the state government or the local government. A couple of examples there. The state of Ohio offers a 10% tax credit for any opportunity zone project that's built in Ohio. Puerto Rico, there are numerous incentive programs, tax credits that are designed to lure investors down to Puerto Rico. The Inflation Reduction Act that was passed last year offers numerous renewable energy benefits and subsidies that opportunity zone developers can often access. And then there's oftentimes, you're able to get different types of TIFs or tax abatements from your local government. I was just in South Bend, Indiana a week ago. I got a chance to speak at the University of Notre Dame, and I was introduced to an opportunity zone project just south of campus, where the developer told me, on top of all of the opportunity zone benefits they're getting, they're also getting, I think it's a 7-year tax abatement from the local government to incentivize them to build there. And then eventually that's going to increase the capital base or the tax base for the local government. But the city of South Bend is offering that for certain projects, at least. So there's just a few different anecdotes there. Remy, I don't know if you had anything else to add on sectors or particular deals that you're bullish on.
Again, we are a little bit more biased towards healthcare. So looking at nursing and home healthcare and such, we're definitely seeing a lot of interest from a real estate perspective, in buying or investing and developing into those type of sectors, like assisted living and such.
Good. And then I'll think that I haven't answered the question yet. So here's what I like, and here's what I personally have invested in terms of my qualified opportunity fund investment portfolio. I'm invested in a variety of multifamily deals across the country. I like multifamily. It has its ups and downs, but I like the long-term trend. We have a housing shortage in this country. I should also mention that I do have a small stake in some of the deals that Seth is working on in Puerto Rico. And I also have a stake in some venture capital funds as well, because I wanted some exposure to some venture capital. So that's a little bit about me. Just kind of to round out this talk this morning. I'm just checking the time. We've got about 8 minutes left here. Any challenges that any of you have faced? I'm curious this is a relatively new investment program. It was only introduced 5.5 years ago. We only got regulations about what, 3.5 years ago, 4 years ago it was. You know, with being an early adopter, there's oftentimes challenges. What challenges has each one of you faced, or are there any other anecdotes about opportunity zone investing that you'd like to share, Jack?
Well, you know, in the project that we're doing in Flemington, this mixed-use town center, we're redeveloping one of the old famous hotels, Union Hotel, which is across the street from where the Lindbergh trial was. And if it weren't for the opportunity zone, that would have been a non-starter. I mean, so when you say it's a challenge, it really helped because it allowed us to raise capital. We had to redevelop this entire block. It was very important to our political leaders that this hotel was redeveloped. So we made it part of the redevelopment. It's a Marriott hotel now. And so in terms of challenges, the opportunity zone really helped us quite a bit. So the only challenge right now is this interest rate environment, which I alluded to before, that we've been trying to mitigate that by giving some returns back to the capital for the people that invest in capital. So that's kind of where it is.
Very good. Seth, just to kind of round out the discussion, how about challenges that you've experienced as an opportunity zone investor, an early adopter into this new program, or any other OZ anecdotes that you'd like to share?
So this newest unique challenge that I am facing is that between the Opportunity Zone program and the tax credits in Puerto Rico and the investment of the IRA, we are looking, for example, for our energy component of our project, that we will have tax credits in excess of between tax credits and deductions in excess of the cost of the energy component, sufficiently enough that we might not be able to take advantage of all the deductions. So we are now trying to figure out how to come up with unique ways to monetize or modify the capital stack in such a way that somebody can take advantage of those deductions so they don't go away. In the case of the energy efficiency, we're looking at somewhere for about every dollar we spend on an energy efficiency, we're looking at a total between IRA and other costs, about 130% in total credits. So
that's pretty impressive. That's
Puerto
really
Rico is unique because of, I mean, you brought up the energy in particular. I think we talked about the, it's not just the opportunity zone, but there's a lot of other, you know, for a given jurisdiction or zone, that you would have a lot of other federal or local benefits or credits that could be applied. And specific to Puerto Rico for energy, there are a lot of benefits that get multiplied. So that's where, again, coming back with the multiplier effect of, you have your direct investment, but then what are the other investments that you can couple up with and partner with other investors and benefit.
But so Puerto Rico is definitely an outlier, but here in Arizona, if I was to do energy efficiency on one of my businesses that's in an opportunity zone, and unfortunately I don't own that building, so it doesn't make sense, I would still be looking at a total between tax credits and the IRA. I could probably clear over 80% of the cost of the energy improvement project in credits, rebates, and opportunity zone benefits. So when you look at how you layer and combine, and this is definitely, you know, not a state that you would expect to see that in. So you just have to look and figure out when you're designing your structures and looking at who you're investing with.
very good. For me, the challenge was just putting this whole thing together, OZ Pitch Day, and then my platform. So I'm a little bit unique in that regard. But you know, it's given me a great view of the industry overall, and it's incredible the different types of people that I've been able to interact with over the last 5 years. I've pretty much seen just about everybody, I think, who's doing any type of opportunity zone development. I'm exaggerating a little bit. There's a lot of capital out there being deployed through captive funds that I really don't have any insight into. I don't know how much, but I think it's in the tens of billions, if not maybe 100 billion or more, type of investments that are going through captive funds, wealthy families that aren't raising capital from elsewhere. But the qualified opportunity funds that are raising capital, I've got a pretty good firm on a pretty firm grip on who they are and what they're doing, and it's been my pleasure really kind of helping to lead this community, lead this industry, to learn more about opportunity zones and do some opportunity zone investing and playing a small part in driving some investment capital into some of these low income communities all over the country. And, like I hinted at, or actually debuted a couple hours ago, I'm really excited that today we're launching our Opportunity Zone investor and professional mastermind group called OZ Insiders. It's launching officially today. You can learn more about that at ozinsiders.com, but we're going to be doing more stuff like this essentially inside that OZ Insiders group, more of these meetings like the one that we just had here today with Jack Cust and Seth Rosenberg and Remy Szykier. My partner Andy and I founded it because there wasn't really a centralized location for high performing opportunity zone investors and executives to meet. That's why we're rolling out ozinsiders.com today. It's our new OZ Insiders mastermind group. We're going to have a once monthly masterclass meeting where we'll dive into specific topics of opportunity zone investing and structuring and other types of tax advantage strategies that you can employ for your own investment portfolio. So that's just a little bit more about OZ Insiders. We are at time. I do want to thank all of my panelists for joining me here today: Jack Cust, Seth Rosenberg, and Remy Szykier. Thank you all so much. Really appreciate your time.
Thanks, Jimmy. Great job.
Thank you.
Yeah.
Wonderful job, Jimmy. Pleasure talking with you.
Thank you. Thank you all.